You've heard it 1,000 times. When a recession hits, buy gold and silver. It's the default advice, the knee jerk reaction for anyone looking to protect their money from crashing markets. But what if I told you that advice is a trap? Because there's one ratio almost no one talks about, the gold to silver ratio. And it's been screaming the same message before every major recession. This isn't a small detail. It's the key that separates savvy investors from the herd. This one number not only predicts that gold will lead the way in the next downturn, but it also gives us a clear, unmistakable signal for when silver is about to explode. So today, we're looking at the numbers that actually matter, the patterns that repeat, and the strategy that could define your success in the next recession. First, let's talk about the conventional thinking. For centuries, gold and silver have been seen as real money, a store of value when paper currencies get shaky. They're tangible. You can hold them in your hand, free from the risks you get with stocks and bonds. So when a recession hits, confidence in the financial system tanks, and investors flock to these safe haven assets. It's a flight to safety. Because of this shared history, most people just lump them together. They see them as monetary twins, interchangeable protectors of wealth. You'll hear analysts say, buy precious metals, as if there's no real difference between them. This is a dangerous oversimplification. While it's true both tend to do better than stocks during recessions, their paths diverge in a big way, especially when a crisis first kicks off. Thinking they're the same is like assuming two fighters with different weight classes move the same when the bell rings. Gold has historically been the true, quote, safe haven, the asset people run to for stability. Silver, on the other hand, has a split personality. It's part money, part industrial metal. And that dual nature is the source of its biggest weakness in a downturn, and its most explosive potential in a recovery. Not understanding that difference could cost you. So, what is this hidden data that changes the whole game? It's the gold to silver ratio. It's a simple but incredibly powerful metric that tells you how many ounces of silver it takes to buy 1 ounce of gold. For instance, if gold is at $4,000 an ounce and silver is at 50, the ratio is 80 to 1. This isn't just a random number. It's a direct measure of their relative value, and its movement is one of the most reliable relative indicators in the precious metals world. When the ratio is high, it means silver is cheap compared to gold. When it's low, the opposite is true. For much of the 20th century, this ratio floated around 47 to 1, but in recent decades, it's been closer to 60 to 1 on average. During a crisis, though, this ratio doesn't just drift, it spikes. On a chart, spikes in the ratio look like vertical shock events, sudden surges that coincide with panic. It tells a story of fear and a predictable pattern that has shown up in recession after recession. This is the hidden truth. Gold and silver's journey through a recession isn't a tandem march. It's a two-act play. In Act 1, gold takes the spotlight. In Act 2, silver makes its dramatic entrance. And the gold to silver ratio is your program, telling you exactly when the scene is about to change. Let's look at the hard evidence. History shows a clear pattern. When economic fear is at its peak, investors don't just want a safe haven, they want the safest haven. That's gold. Gold is almost purely a monetary asset. Its value is driven by its role as money, a hedge against inflation, and a port in a storm. Around 85% of its demand comes from investment and central bank buying, so it has very little industrial use to hold it back in a slowdown. Silver is a completely different animal. Over half of its demand is industrial, making it a key ingredient in everything from electronics and solar panels to cars. When a recession hits and manufacturing slows, this industrial demand plummets, acting like an anchor on the silver price just as investment demand is trying to push it up. Gold doesn't have that problem. You can see this dynamic perfectly in past recessions. During the 2008 financial crisis, gold held its ground as stocks collapsed, but silver's price initially fell by over 50%. The gold to silver ratio spiked to over 80, showing gold's dominance. Then, during the COVID panic in March 2020, the same thing happened, but even more dramatically. The ratio exploded to an all-time high of 125 to 1. Gold was the ultimate sanctuary, while silver got dragged down by fears of a global shutdown. While gold has often gained during recessions as stocks decline, silver has a more checkered past, having only managed to outperform the S&P 500 in 3 of the last 8 recessions. This doesn't mean silver always falls in recessions, but it does mean it usually underperforms gold when fear peaks. The takeaway is crystal clear. In that first, fear-driven phase of a recession, the smart money flows to gold first. But the story doesn't end there. This is where the real opportunity shows up. The moment that separates those just trying to survive the storm from those positioning for the boom that follows. The same ratio that signals gold's dominance also tells us when silver's moment has arrived. History shows that after the gold to silver ratio hits an extreme peak during a recession, it tends to fall hard. And when the ratio falls, it means one thing: silver is outperforming gold. A ratio above 80 has historically been a huge buy signal for silver. Think of it like a rubber band being stretched to its absolute limit. That peak ratio represents maximum pessimism towards silver. But once the initial panic cools off and people start looking toward recovery, the whole dynamic flips. Governments and central banks fight recessions with massive stimulus. This leads to fears of inflation, driving investment in both gold and silver. At the same time, as the economy shows signs of life, industrial demand picks back up, removing the anchor that was holding silver down. Silver, with its much smaller market, gets a supercharged boost from this dual wave of demand. It's no longer just gold's little brother. It becomes a leveraged play on both monetary fears and economic recovery. That volatility cuts both ways, which is why timing and sizing matter. Look at what happened after 2008. From its low to its peak in 2011, the price of silver skyrocketed by over 400%. After the ratio peaked again in 2020, silver went on another incredible run, more than doubling in price and leaving gold in the dust during the recovery. The signal is consistent. A high gold to silver ratio often marks the turning point where smart money starts betting on silver's explosive catch-up. So, what does this all mean for you? How can you turn this history into a real strategy? This isn't financial advice, but it's a framework for thinking based on decades of data. The evidence points to a 2-phase approach. Phase 1, capital preservation. As a recession starts, gold is your primary shield. Its historical consistency makes it the more reliable asset to weather the initial storm. And while gold is providing that stability, your job is to watch the gold to silver ratio like a hawk. Phase 2, asymmetric opportunity. The signal to shift your focus is that spike in the ratio to extreme levels, historically above 80 to 1. This tells you that silver is likely on sale compared to gold, and that the market has priced in the worst-case scenario. This is the signal that the silver explosion could be next. At that point, you might consider rotating assets to position for silver's potential to outperform not just gold, but almost everything else in the recovery. It's a strategy of using gold for stability in the storm, then using the ratio as a trigger to get ready for silver's powerful rebound. If you want to stay on top of data-driven insights like this to get ahead of the big market shifts, make sure you subscribe and hit the notification bell. In the next video, we'll connect this ratio to bond signals and liquidity, because metals don't move in isolation. You'll want to see what we're covering next. The common wisdom that gold and silver are interchangeable safe havens is simply flawed. The data tells a much smarter story. In a recession, gold leads first. It's the undisputed king of safety when fear is in control. But silver, dragged down by its industrial side, gets deeply undervalued, causing the gold to silver ratio to hit historic highs. That spike isn't a reason to write silver off. It is the signal. It's the starting gun for the second act, where stimulus and recovery create the perfect conditions for silver to surge, delivering gains that often dwarf gold's. By understanding this 2-act play, gold for defense, silver for the rebound, and by using the gold to silver ratio as your guide, you can move beyond the simplistic advice. You can start investing with a clear, data-driven strategy. Forget the noise. Watch the ratio. Are you watching gold, silver, or the ratio itself? Drop it in the comments.